Hi everyone, welcome back to Trading Chat Legends. I start this channel because I believe that the greatest lesson in trading don't come from indicators or strategies. They come from the stories of legendary trader who live through failure, lost and come back stronger. Every week I bring you one of those stories. If that resonate with you, subscribe and join the journey. Let's get started.
Most traders spend their entire lives thinking about how to make money, how to find the right setup, how to enter at the perfect moment, how to maximize the profit on every trade. And that focus, that constant obsession with the upside, is quietly the thing that destroys most of them. Because there was one trader who thought differently. A trader who built one of the most extraordinary track records in the history of financial markets, not by obsessing over profits, but by obsessing over something else entirely. Over losses. Over risk. Over what could go wrong before he ever thought about what could go right. His name was Paul Tudor Jones. And the way he thought about trading will permanently change the way you think about it too. This sounds like a simple shift. It is not. For most traders, thinking about losses first feels like pessimism. It feels like you are setting yourself up to fail. It feels like you are not believing in your own trade. But Paul Tudor Jones understood something that took most traders decades to see. The traders who last are not the ones who are right the most often. They are the ones who survive long enough for their edge to play out. And surviving requires something that has nothing to do with being right. It requires protecting your capital with an intensity that most people are simply not willing to bring to it. That he developed a rule that became the foundation of everything he did. Before entering any trade, he would identify the exact point at which the trade was wrong. Not where it might be wrong. Not approximately where it would be wrong. The exact point. The specific price level at which the reason for being in the trade no longer existed. And at that point, without hesitation, without hope, without any negotiation with himself, he would exit. Full stop. No moving the stop to give it more room. No averaging down because the price looked even better at a lower level. No staying in because the fundamentals still made sense. If the price reached the level where the trade was wrong, the trade was wrong. And he was out. This discipline sounds straightforward when described in words. In practice, it is one of the hardest things a human being can do inside a financial market. Because when a position moves against you and approaches your stop level, every instinct you have tells you to hold on. The price is so close to where you bought. If it just comes back a little. If you just give it a bit more room. If you just wait one more candle. These thoughts feel like intelligence. They feel like patience. They feel like the kind of careful thinking that separates a thoughtful trader from a reckless one. Paul Tudor Jones knew they were none of those things. They were fear. Fear dressed up in the language of reason. And he refused to listen to them, but it was one specific moment in Paul Tudor Jones's career that elevated him from a very good trader to a legend. And that moment came in 1987. To understand what he did, you need to understand the atmosphere that existed in financial markets in the months leading up to October of that year. The stock market had been on an extraordinary run. Prices had been climbing for years. Confidence was everywhere. Most professional investors and analysts were bullish. The prevailing wisdom said that the economy was strong, that the market was healthy, and that anyone who was worried about a correction was simply not seeing the full picture. Paul Tudor Jones looked at the same data that everyone else was looking at. He studied the same charts. He read the same reports. And what he saw made him deeply, genuinely uncomfortable. Not because he had special information. Not because he had access to some secret data that no one else could see. But because he had a habit of mind that most investors did not. He was always, constantly, relentlessly asking the question, what if I am wrong? What if the thing that everyone believes is true turns out not to be? What does the downside actually look like? And when he ran those calculations in the autumn of 1987, what he found shook him. He began positioning for a significant market decline. While the majority of the investment world remained bullish, while money was still flowing into stocks, while the financial press was still writing about the bull market, Paul Tudor Jones was quietly building positions that would profit enormously if the market collapsed. And on October 19, 1987, a day that became known as Black Monday, the United States stock market fell by over 22% in a single day. The largest single-day percentage decline in stock market history. Fortunes were wiped out. Funds collapsed. Careers ended. And Paul Tudor Jones tripled his money. Let that sit for a moment. On the single worst day in the history of the American stock market, Paul Tudor Jones tripled his investors' money. Not because he was lucky. Because he had asked the question that almost nobody else was willing to ask. What if everything goes wrong? What does the worst case actually look like? And then he had positioned himself accordingly. While everyone else was focused on upside, he was protected against the downside. And when the downside arrived, as it always eventually does, he was the only one in the room who was ready for it. The lesson of 1987 is not that you should always be pessimistic. It is not that you should always be betting against the market. The lesson is something far more specific and far more useful. The lesson is that the traders who survive the longest are the ones who never stop asking what can go wrong. Who never let the comfort of a winning position or a rising market make them forget that the market can turn without warning. Who always know exactly how much they are willing to lose before they are proven wrong. Because the market does not care how long you have been right. It does not care about your track record. It does not care about your conviction. It will move against you without a moment's notice. And the traders who are ready for that, who have already decided in advance exactly what they will do when it happens, are the ones who walk away intact. Paul Tudor Jones has spoken in interviews about his approach to risk in a way that has stayed with traders for decades. He said that he is always thinking about losing money rather than making it. That the most important thing for him is not the potential profit on a trade but the potential loss. That he wants to know, before he puts on any position, exactly what the worst case looks like. And that if the worst case is something he cannot live with, he makes the position smaller until it is. This is not timidity. This is not a lack of conviction. This is the most sophisticated form of trading discipline that exists. The ability to separate your belief in a trade from the amount of capital you are willing to risk on it. Most traders do the opposite. They find a trade they believe in strongly and they size it large because of that conviction. And when the trade goes wrong, as even high-conviction trades sometimes do, the loss is devastating. Not just financially. Psychologically. And that psychological damage causes them to make the next decision from a place of pain and desperation rather than clarity and process. Paul Tudor Jones never let himself get to that place. Not because he never had losing trades. He had plenty. But because every losing trade was sized in a way that he could absorb the loss without it damaging his ability to think clearly on the next trade. That he talked about this in terms of what he called the 1% rule. Never risk more than 1% of your total capital on any single trade. At first glance this seems extremely conservative. Almost impossibly conservative for a trader who made the kind of returns Paul Tudor Jones produced. But think about what that rule actually does. If you never risk more than 1% on any trade, you can be wrong 10 times in a row and still have 90% of your capital intact. You can absorb a losing streak that would completely destroy a trader who was risking 10 or 20% per trade. You survive. And in trading, surviving is everything. Because the trader who survives long enough will eventually find the trades that make back everything and more. The trader who blows up never gets that chance. There is something else Paul Tudor Jones understood that separates him from most of the traders who came and went during his career. He understood that the market humbles everyone eventually. That no matter how good you are, no matter how many years of experience you have, no matter how refined your method becomes, the market will find a way to surprise you. And the traders who respond to that surprise with humility, who acknowledge when they are wrong and adjust quickly, who never fall so in love with a position that they cannot cut it, those are the traders who last. The traders who respond with ego, who hold on because they cannot accept being wrong, who double down because they believe they are smarter than the market. Those are the traders who eventually face a loss they cannot come back from. He has said that he believes his best quality as a trader is not his analytical ability. It is not his understanding of macroeconomics or his ability to read market structure. It is his willingness to be wrong. To recognize a mistake quickly and exit without drama, without self-blame, without trying to make the trade work through force of will. Just out. Clean. Move on. Look for the next opportunity with a clear mind. This sounds simple. For most traders it is the hardest thing they will ever try to do. Because being wrong feels like failure. And the natural human response to failure is to try to fix it. To stay in the position. To wait for the market to come back and make you right. Paul Tudor Jones trained himself out of that response completely. For him, being wrong was just information. Just a signal that the thesis had not played out. Nothing more. Nothing personal. The broader lesson of Paul Tudor Jones's career is one that applies whether you're trading stocks or Forex or commodities or anything else. It is a lesson about where your attention should actually be. Most traders focus almost entirely on entry. On finding the right setup. On getting in at the perfect price. On timing the trade correctly. And entry matters. But Paul Tudor Jones would tell you that entry is maybe 10% of the game. The other 90% is what you do after you are in. How you manage the trade. How you respond when it goes against you, whether you move your stop or hold it. Whether you exit cleanly when you are wrong or whether you let hope make the decision for you. The entry gets you into the game. Your risk management determines whether you stay in it. Decades after his greatest trades, Paul Tudor Jones remains one of the most respected figures in the world of finance. Not because he never loses. He loses. Not because he always calls the market correctly. He gets it wrong. But because through all of it, through every market cycle and every period of difficulty and every trade that did not work out, he has maintained something that very few traders ever truly build. A consistent, disciplined, deeply ingrained respect for risk. A refusal to let any single trade, no matter how compelling it looks, threaten his ability to continue. A daily, deliberate commitment to asking the question that most traders are afraid to ask. What if I am completely wrong about this? That question is not comfortable. It does not feel good to ask it. It does not feel like the mindset of a winner. But Paul Tudor Jones built a career that most traders can only dream of by asking it every single day. Before every trade. In every market condition. At every stage of his career. The question protected him when he was right about the direction but wrong about the timing. It protected him when the unexpected happened and the market moved in a way that nobody saw coming. It protected him from himself, from the part of every trader that wants to be right so badly that it stops thinking clearly about what being wrong would actually cost. You will have trades that you are certain about. Setups that look perfect. Moments where everything lines up and the confidence you feel is real and earned and based on genuine analysis. In those moments, ask the question Paul Tudor Jones never stopped asking. What if I am wrong? How much am I willing to lose to find out? Make that number specific. Make it a number you can genuinely live with. Size your position accordingly. Place your stop at the exact level where the trade is proven wrong. And then let it work. That is the whole game. Not the entry. Not the analysis. Not the conviction. The willingness to define your risk before you define your reward. And to honor that definition no matter what happens next. Paul Tudor Jones did not become a legend by being right more than everyone else. He became a legend by surviving long enough, and protecting his capital carefully enough, that when the big moments came, he was still in the game to take advantage of them. That is available to you too. Not the billion-dollar fund. Not the resources or the team or the infrastructure. But the mindset. The discipline. The daily practice of asking what can go wrong before you ever ask what can go right. That mindset costs nothing. And it is worth everything.